Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby, and I'm joined today by my friend and colleague, Tim Holland, who is the Chief Investment Officer, OCIO, at Orion, where he consults with Orion's largest customers, growing their firms through our OCIO services. He joins me every year at Ascent. If any of you have attended Ascent, you've seen us there for our popular Mind in the Market segment, and he's here today to talk about the all-important topic of the ins and outs of investing in a crazy election year. Tim, welcome to the show.
Daniel, great to see you. Thanks for having me on. Always a pleasure chatting with you. And we got a lot to talk about considering the calendar, and we're getting into campaign season. I think the first debate, as I look at my screen, is 3 weeks away. So yeah.
I will try and remain apolitical throughout, but I have to tell you, I've been in deep denial that this is an election year. I think I've been kind of dreading in a purple state, as I know you do.
Yeah.
There's a lot I like sort of philosophically about living in a state where there's diverse viewpoints. The ads are pretty insufferable when it gets to be that time. There's a lot of science to this, right? There's a lot of science to this. And we did a presentation together earlier this year, our Market Outlook webinar, where we talked about some of the evidence behind what it looks like. And I think this is great for the advisors that listen to this show to listen to and to understand, so that they will have some talking points for their clients. They can empower their clients. Let's start, Tim, with the presidential cycle pattern, right? If you look at 4 years of a term, historically, a president's first and fourth years in office have been good, not great. That's where we are this year, and we're off to a hot start relative to history. The second year has been kind of dead. The second year has been kind of the flattest of the bunch, and the third year has been the best.
Yeah.
Is this noise? Is there some method to this madness? How should we think about this presidential cycle pattern and where we find ourselves in 2024?
Yeah, I think that there's some method to the madness, though. As hard as folks in our industry have tried to quantify it, I don't think they've ever gotten there, right? But sort of the received wisdom, if I'm using the term properly, is if you plot out those 4 years, to your point, the bookends are kind of the third year is phenomenal. The second year is really unpleasant. And this goes back a very long, decades and decades of market performance, regardless of what party controls that end of Pennsylvania Avenue. And so the thinking, the method, as it were, as it is that a new president comes into office, and the first year is when they're going to start to put in place, sort of their legislative agenda, right? And unless you're FDR in the early 1930s, the famous 100 days, nothing ever moves all that quickly. Obviously, he sort of upended everything way back when. So you kind of spend your first year getting your legislative program in place. And the idea, the thinking is, well, whatever medicine you're going to take, you're going to take early. So if you're going to raise taxes or cut spending or make some unpleasant decisions from a fiscal policy perspective, let's get that out of the way, right? So you kind of come in your first year, you're going to sort of put that in place. And the idea is, if the economy takes a step down because of some difficult decisions DC is making, and as the economy takes a step down, corporate profits should take a step down. That's going to hit in the first half of that president's terms. Sort of do the work in the first year, hits the second year, and then there's a great line, I think, in Clear and Present Danger with Harrison Ford, right? Jack Ryan used to love the Tom Clancy movies. Truth be told, I never saw the Ben Affleck versions. I guess I'm a old fogey that way, where the chief of staff is talking to sort of the deputy director of national intelligence and nefarious folks. And he says something along the lines of, this first term administration wants what every first term wants. And the guy's like, what's that? He goes, a second term, right? So the idea is you take your medicine early, and then your third year, back to sort of the legislative priorities and the pipeline, that's when you want to, maybe somewhat cynically, juice the economy, right? You want people feeling good about the state of the world as you go into the back half of your term. And the idea is that's when, after you've taken your medicine, that's when you get to enjoy the sweets and the good stuff. So maybe you pump up spending, maybe you look to cut taxes into the back half of your term. That unleashes animal spirits, that gets the economy growing a little bit better. That gives corporate profits a little bit of a boost. Markets are up and to the right, and then people are feeling pretty good about you and your stewardship as they get ready to move into the final year of your term and get ready to go to the voting booth and make their decision. So that's kind of, or that is the thinking around the presidential term, and why you've seen that very consistent cycle where year 2 is pretty unpleasant from a market perspective, but year 3 in particular is up and to the right.
Okay, that's actually really helpful. I tend to be pretty cynical about these things and just sort of think it's sort of a noise artifact, but that actually all makes a lot of sense. Let's zoom in further on the calendar from that cycle now and talk about the election year itself.
Yep.
So the election year itself, if we're looking at history, right? Your mileage may vary, but the first 2 months are typically flat to slightly positive.
Yep.
March and April have historically seen a bit of a sell-off.
Yeah.
And it tends to be up and to the right until October, where there has historically been a fairly sizable dip, right?
Yeah.
Before it trends back up over the end of the year. So obviously every year varies. This year, we're up fairly handily, even, midway through the year.
Yeah.
What's the psychology of this? What does this general trend say about how we should think about time effects in an election year?
Yeah, and I think this year, right, this is an unprecedented year from a political, or almost unprecedented, right? It's the first time you've had 2 presidents running against each other in over 100 years. So this kind of doesn't happen, right? So it is unprecedented. You have, in terms of the age of the candidates, maybe how polarized we are, maybe not unprecedented, but pretty darn polarized. And the fact that you have a former president running against a sitting president, it's only happened once before. And so I think about that as I think about, to your point, the historic pattern during a presidential election year, which is some weakness, those couple sort of March, April. And we had a good March and a tough April. We got it all back in May, at least using the S&P as a proxy for the broader market. And the thinking behind that pattern is, okay, you go into an election year, typically, if you don't have an incumbent, say you've got a 2-term president, so you've got an open seat on one side and obviously an open seat on the other, there's some uncertainty around who's going to be those standard bearers for the 2 major parties. And you kind of start to sort through that come Super Tuesday, right? Sort of the March primary, every state kind of front end loaded their respective primary because they wanted to be more important. Obviously, it used to be New Hampshire and Iowa. The Democratic Party changed that a little bit. So that's the thinking there, that you usually get some volatility to the downside in an election year because you have at least one unknown, right? You've got one party that doesn't hold the White House, so they were going to have to figure out who their candidate is. And maybe you have 2 unknowns, and that, say it's a 1988 situation where Ronald Reagan can't run again, and you had a pretty aggressive open primary where George H.W. Bush finally got the nomination. So as you kind of figure out who the major party candidates are, people kind of catch their breath. They're not so worried about the markets and the economy, and that volatility dissipates. And then to your point, you go into fall, and typically markets sell off into election day. And there, I think it's just heightened uncertainty around who's going to win. And people really start to pay attention during the election year, kind of August, September. So that's when people really start to concentrate on the race. And that usually bleeds into some volatility into the market. And then if you think about this year, and we were talking about this at Ascent, and you touched on this earlier, with all due respect to President Biden and President Trump, I think most of the country, or a big chunk of the country, would be okay if we had 2 different folks to choose from. I'm just saying that, right? It's a pretty difficult dynamic right now. So think about come October this year. Say the race is this close, right? And we've already talked to clients and had these conversations where I think people are genuinely afraid of election day and what's going to happen. So if markets tend to be volatile into the fall in a normal election year, not that I am predicting this, I would think that's going to be on steroids this year. People are just going to be nervous. Not so much maybe about election day, but are we even going to get through election day? And we will, but how uncertain is that 48, 72 hours going to be as they count ballots, and maybe some states are close. So that's kind of the thinking behind election year volatility. I would think come this fall, if these are our standard bearers, it's going to be even more pronounced. We'll get through it, but I would not be shocked to see some volatility and some weakness come October and early November.
You know, guys, this is why I bring Tim on the show. He has encyclopedic knowledge of history and political history, but also bad 80s movies and different forms of media. So the combination is incredibly potent. But, you know, I think you make an excellent point. I mean, we're sitting here talking before we hit record. It's June 6th when we're recording this, surely July when it airs. But, you know, it's June 6th and President Biden had some lapses, you know, this morning at an event commemorating D-Day. We know that in mid-July, President Trump will be sentenced. I mean, there's a level of uncertainty that's really unprecedented. Yeah. And then when you look at those calendar effects on the markets, it's really the resolution of uncertainty that drives markets upwards, and the presence of uncertainty that drives them downwards. I think that's what accounts for those calendar effects. So it's interesting to think about what that will look like in a year where uncertainty is as great as it is. Also, shameless plug, if you haven't listened to my episode with Dr. Naomi Wynn on the science of uncertainty, she breaks it down in some really fascinating ways. You know, I think if there's just one takeaway from all of this, I don't want any of our conjecture or our speculation to obscure this most powerful message. It's one I've seen you talk about recently, and it's that markets tend to rise regardless of who is in the White House. Yep. So we know that political polarization in this country is growing and has been growing for 50 years. You know, from a psychologist perspective, we've moved from the era of Walter Cronkite, where you had this relatively single source of truth, centrist position, to now where everyone can get their unique flavor of bias catered to through the through the media they choose to consume, and I think that drives a lot of it. Yeah. I think this bears repeating, right? I see one of the biggest behavioral biases. You and I just gave a presentation in Phoenix, and a woman came up to me afterwards, and her question was, my clients treat politics like religion, and they really want to invest their politics in the same way like an ESG investor might want to invest their political beliefs. What would you tell clients or advisors who have this impulse to try and invest their politics?
That's a really interesting question and a great question. So my 2 cents would be, as it concerns whatever party controls the White House, and obviously have the other end of Pennsylvania Avenue and the makeup. So and not to sound cynical or flip, but, and you've done some great research on this, and I hope I'm not stealing some of your thunder. You're not hurting anyone but yourself if you decide to kind of move to cash because the person that you don't like is now the most important person in the world for the next 4 years. I mean, I get the angst and the anger and the disappointment, but, with all due respect, whoever sits in the White House, unless you're personal friends with them, has no idea who you are and doesn't really know or care that you're mad at them. Now, I know that can get hard to get our heads around, but it's something I've sort of come to appreciate as I've gotten older. Sort of my mindset, my framework is my decision. And so I'm going to try and choose the best one, the best possible one, the healthiest one. So that's the first thing. And then to your point, Daniel, the markets go up and go down regardless of who's in the White House, and the economy expands and contracts regardless of who's in the White House. But over time, GDP goes up and to the right, and the markets go up and to the right. And so why wouldn't we selfishly want to participate in that, build wealth, be able to pay our bills, leave a legacy, buy that vacation home that your kids and your grandkids and your great-grandkids can all go to and enjoy and make memories? Because that's kind of what all this is about, right? It's not about the money itself, at least not for most of us. It's what the money can do for you. And there's never been a mechanism, a machine for creating wealth like the U.S. economy in the history of the world. And so if you just pick two starting points, 1960, John F. Kennedy gets elected, the S&P is sub 50, and now we're going into a rematch of President Biden and President Trump, and the S&P is at 5,400. And think about all of the scandals and all of the rhetoric and all the anger and all the disagreements and all the domestic internal tension and the different standard bearers and the parties and the pundits that we had to live through and experience over those 64 years. And if we let ourselves get caught up in any of that, we just watched the S&P go from 50 to 5,400, and it didn't benefit us or our spouses or our children or our grandchildren at all. So you gotta, in my opinion, not to sound bossy, you gotta put that down. You gotta put that down and focus on the fundamentals. And over time, the economy grows and profits go up and markets follow.
Yeah, the way that I put it in our market outlook webinar is like, don't add insult to injury, right? Like if your guy doesn't win, right? If you don't want to harm yourself twice, you've already got to deal with the whoever you don't like being in power for the next 4 years. Don't compound that by hurting your family, by taking yourself out of the great wealth creation engine.
You're only hurting yourself. Yeah, no, well put.
Yeah. So, just to add some color to this, this is some research I shared on LinkedIn recently. I found a really exhaustive study. It looked at 60,000 retail investors over decades. And they found really three things. The first thing that they found was that they tended to have a 9% larger stake in foreign stocks when their non-preferred party was in power. Yeah. So they got less bullish on the U.S. When my person's not in charge, I'm going to have a greater allocation internationally, which is fascinating because I feel like I scream about the benefits of international diversification all the time, and no one listens until
you just need folks to identify by political party, and then you'd probably find a more receptive audience depending on how election day went.
Yeah. The second thing they found was that portfolio beta was higher when the third party was in power. So there was an aversion to risk, when my person's not in charge, play it safer. And then the final thing they found was a 2.7 annualized underperformance.
Wow.
When your person was not in power. And it was because of, these variables, lower allocations to the US, lower risk taking, and also more action bias, jumping in and out of the market. Any comment on these sort of three findings there?
They're fascinating, and I believe it. And they're tragic because if you're underperforming by 2.7% per annum over 4 years, you've left over 1,000 basis points because of compounding on the table. And that's a lot of money. That's a real move higher in risk assets. So I think they're fascinating data points. They're not disappointing, but you're only hurting yourself if you let your political biases drive your interest or willingness to invest in the world's most important economy, which is ours, and the world's largest most liquid and deepest capital markets, which would be ours. And, I think back over the last 20 years or so, and I'm sure there's some folks listening to this that are big fans of former President Obama, and I'm guessing some folks who aren't. And the same thing with, say, Donald Trump or President Trump. I remember I've been in this business for a while, traveling with a very well-known portfolio manager, Barack Obama won in 2008. And this was a professional investor. He almost went completely to cash. He had the flexibility to do it. He was so displeased with the senator from Illinois, and the markets just ripped. Once we bought him in early 2009, he was out of business. So not only did he do his clients a terrible disservice because it wasn't about fundamentals, it was about political biases, he ultimately lost his investment advisory business, and he was abandoned by clients en masse. And that was just shocking to me. He was so worked up. And this was a fiduciary, right? So we're all susceptible to these biases, right? Daniel helps us figure this stuff out. And then if you fast forward to Donald Trump's election, I won't name the pundit, but arguably one of the world's best known economists took to the blog of arguably the world's best known newspaper. And as futures were selling off, as Donald Trump shocked the world by winning the Electoral College, wrote, "When will markets recover from a Donald Trump presidency?" And his answer was never. And then markets not only recovered over the next 4 years, they recovered overnight, and the Dow was up the next day. So these are very smart, well-educated, very prominent professionals, and they're susceptible to it. So it's harder for us to figure this stuff out, but you're just hurting yourself. The universe is somewhat indifferent when it comes to the markets and our political beliefs. So you just got to put it down. You got to put it down.
Yeah, presidents get too much credit and too much blame, and the engine of the economy, thankfully, is bigger than any one person.
That's great point.
The pundit in question in your second example, a Nobel Prize winning economist, also poo-pooed the internet and said the internet would be no big deal. So maybe we should go back and read the chapter in The Laws of Wealth about the perils of forecasting.
Yes.
Because very smart folks can say very dumb things.
Yeah, for sure. It just sounds good when they say it because they're so smart. Their vocabulary is so much better than mine. Anyway, good point.
So Tim, I love a good sort of paradoxical finding. I love it when my expectations are challenged and I get surprised. And you did that in a recent presentation where you talked about contentious Congress being optimal. That surprised me and I loved it. So can you tell us why we want political gridlock?
Yeah, no, and I love it when you use big words like paradoxical. See, this is good for me too. I just learn stuff. I'm writing stuff down and then I got to go Google some stuff.
Three words for you. Alabama Public Schools.
There you go. Alabama Public Schools. Well done. It was they did a good job, and I'm sure you worked very hard too. So contentious Congress. So we've all been in this business for a little bit. Wall Street's full of all sorts of adages and cliches and all that. And one is gridlock is good. And I first heard that in 1994 when Newt Gingrich, great state of Georgia, right, where Daniel lives with his lovely family today, proud product of the Alabama Public Schools. Newt Gingrich sort of shocked the world and using what was known as a contract with America. In politics, you want to lay out some principles and you just repeat them and you go from there, helped the Republicans take the House for the first time since the Eisenhower administration. And people were kind of blown away. And markets were we had a recession in the early 90s, and then markets got a little bumpy. The Fed was raising rates. The bond market was misbehaving itself. And then the Republicans, not to give them all the credit, won the House, and all of a sudden you had divided government, right? Bill Clinton had come in 1992, hadn't won a majority outright because of Ross Perot and a third-party candidate, but was president and had both houses. The Democrats had both houses of Congress, the House and the Senate for the first 2 years, and then you had gridlock, and markets just took off. Bond yields came in. We started talking about cutting the deficit, putting our fiscal house in order. Obviously, the internet started to become a big thing, and we had a phenomenal run for the next 5 or 6 years. And so that's when I first heard the term gridlock is good. And the idea is, from a political perspective, as it ties back to the market, another adage or cliche is that the markets hate uncertainty. So if you have divided government, the odds of something big happening, passing the Congress and being signed by the president in a way that maybe impacts the economy in a way that the economy or the markets don't like, goes way down. Think about DC today and how little the Democrats and Republicans have been able to get done, and what a Herculean task it was just to come together around funding for Taiwan, Ukraine, and Israel. And that almost didn't happen a couple of times until it finally did. So to Daniel's point, if you look at the S&P 500 going back about 90 years, typically the market's giving you about a 9% average annual return, maybe a little bit higher than that when you include dividends. If you look at the markets, again, going back to the 1930s, when you've had a contentious or divided Congress, doesn't matter if a D or an R holds the White House, you've got a split Congress, House and Senate. The S&P is giving you over 13% per annum. So 400 basis points or 4% more, which is a massive bit of outperformance, and compounds over time, becomes super, super meaningful. And the idea is, again, gridlock is good. Contentious Congress is best because it mitigates the potential for big macro surprises that upend important parts of the economy or upend the market. And if that doesn't happen, if you're a CEO, you know what the rules of the road are. You can go run your company. If you're an institutional investor like a pension plan, you have a pretty good idea around what taxes will look like, what fiscal policy will look like, and you can position your portfolio accordingly. And so I do think as we go into the summer, further into the summer, or I guess we haven't hit summer just yet. When is the first day of summer, Daniel? Do you know?
I don't know. Listen, the official starts and stops of the seasons is kind of like official classifications of certain foods, like a tomato is a fruit. No, it's not. Like summer starts when the kids get out of school. So summer starts. Are
your kids out yet?
Oh, they're out. Yeah.
Oh, good.
Yeah.
So whenever we hit summer, and then the fall. So, my 2 cents is if it's President Biden versus President Trump, it's a coin toss to be decided by 6 or 7 states, including the great state of Georgia, where I am, the Commonwealth of Pennsylvania. And I do think the other end of Pennsylvania avenue is likely to remain divided. The Republicans hold the House by the thinnest of margins, 2 or 3 seats, with some retirements and one representative being expelled. And the Democrats hold the Senate by 2 seats, the thinnest of margins. And you've got an electoral map that really favors the Democrats on the Senate side. So my best guess is whoever wins the presidency, the other end of Pennsylvania Avenue will remain divided. You'll have a contentious Congress, and I think the markets will be A-OK with that outcome.
It's this is why I love people like you who understand the markets, because in my books I talked about Wall Street bizarro world, like the rules of every day don't sort of common sense doesn't always translate. It's weird to think that inaction and gridlock and contention could be what the doctor ordered, but here we are.
Yeah.
For the final question, Tim.
Yeah.
The affect heuristic is real, right? This tendency for emotion to color perception and for our emotional state to color sort of everything we do is real.
Yeah.
And I have tried throughout to remain apolitical, but you mentioned it earlier, so I'm emboldened to go there now.
Yeah.
To feel like people are excited about their options, right? Like I don't feel like by and large people are excited about the choices they're faced with this November.
Yeah.
And with that, I worry, that there will be an accompanying lack of enthusiasm for markets and things like that.
Yeah.
If people are experiencing what Kyla Scanlon calls a vibe session, right? The economy's good, the vibes are off. That's kind of how it feels right now.
Yeah.
If people are experiencing a vibe session and they're worried about things, what would be your counsel to them?
Yeah. So one thing I'm keeping in my back pocket as we go through 2024 is a data point that ties back to a presidential election year. So, and again, when you talk about forecasting how difficult it is, and that was part of the Ascent presentation, no one has that crystal ball. So what I do is I think about history and patterns and the repetition or potential repetition of those patterns. And this may sound very, very simple, but the economy expands about 90% of the time. We've only been in a recession about 10% of the time in the last 45 years, and markets go up about 80% of the time. So me personally, professionally, I want to put the odds in my favor. So I'm an optimist, and I assume most of the time the economy will be okay, markets will be okay, and then when they're not, you have to adjust accordingly. So I like to lean heavily on history, especially during periods of uncertainty and stress. So the other data point would be back to election years, presidential election years, when you have an incumbent seeking another term. So if you go back to 1944, when Harry Truman had served out the rest of FDR's last term, and then obviously ran for re-election later, and then came back and beat Thomas Dewey, and there's a great Dewey defeats Truman headline. we've had 13 presidential election years where an incumbent was seeking another term. And in all 13 years, this is pretty interesting, the market was positive 13 for 13, and the average return was 16%. So again, begs the question, is there a method to the madness? So if you go back to the presidential cycle and the idea that, the president's going to sort of do everything in their power to set things up for a second term, well, that dynamic, that presidential cycle, that third year into the fourth year is probably going to be even more pronounced when it's an incumbent who's trying to hold on to his seat, because not to try and get in the head of the late Ronald Reagan, he wasn't going to be on the ballot in 88. Maybe he cared deeply about the Republican Party holding the White House. I'm sure he did, but it's got to be a different dynamic, I would think, in a very subconscious way when it's your job and it's the most important job in the world. So here we are, up 12%, knock on wood, on the S&P. If history is any guide, we're going to be up and to the right in 2024. And I think we will be. Bond yields have moderated. Inflation's come in a little bit. Corporate profits are okay. I do expect some volatility, especially around the election. But if history's any guide, knock on wood, when 2024 is all said and done, we're going to be 14 for 14, regardless of whether or not Joe Biden wins. The important point about that 13 for 13 is the market was always up, whether or not the incumbent held on to the White House or not. That pattern persisted either way.
Yeah. Well, this has been fantastic, just chock full of great information. From my part, my closing shot here, I want to share some of the things that I talked about in our Market Outlook webinar, some things that I think advisors can do. The first one, you just need to inoculate your clients a bit. You need to help them expect the noise, the negativity, and all these things, just so they're not surprised by these things. I think the next thing I really kind of pound the table on this lately is just, we need media training. Like we need to instruct our clients how to be informed consumers of media, how to moderate their media diet so that they're not putting themselves in a constant state of panic. And then the last thing, next to last thing would be just letting them know about some of the stats that Tim has shared today. Like there's comfort, there's certainty in those stats, and it gives a sense of, nothing's certain, but it gives a sense of form and structure to these things. And then the final thing is replacement behaviors, right? Just because you can't impact the American political system with your going to cash, right? Or you're going highly levered long because you like or hate whoever is in office, there are things you can do. So I think replacement behaviors, certainly voting, activism, charity, advocacy, all of these things, get involved in the political process in the right way. Just don't do it. Just don't do it with your 401k, right? Like just don't do it with your portfolio. I think there's lots of great ways.
Yeah, no, it's really well said.
Yeah. So Tim, 30-second commercial for OCIO on the way out. Tell us where people can learn more about OCIO and what y'all do there.
Yeah, so if you go to Orion Advisor Solutions, the website, you'll see a link to OCIO Outsourced Chief Investment Officer. You can learn more about our offering there. It's an interesting part of Orion where we bring together a trading team, a proposal process, and a portfolio audit process, a well curated and thoughtfully constructed investment management platform, client facing content support. I do a lot of client events, macro and market economic analysis, materials that the advisors we work with can white label, brand with their name and their firm's name. So it's really a place where it's a holistic partnership between the advisor who wants to access really everything that Orion has to offer in one spot, and where the advisor in particular is comfortable outsourcing from an investment perspective, but really wants to grow. Sort of knock on wood, the folks we work with and have worked with over the years have grown at a disproportionate rate relative to the industry. And we're really built that way and set up that way to partner with a limited number of advisors who want to run really hard, want to have more time to focus on existing clients, and want to go out and get that next client. And that's what we've been able to do for a while now.
Yeah, it's a great part of our business, located in one of the finest cities in America.
Yes, Provo,
Utah.
spot. Good spot.
And Tim, you're a legend. Thank you for doing this. You shared so much great stuff with us today. I really appreciate it. Thank you again.
It's always great being with you, Daniel. Always learn a ton when I talk to you. So thanks again for the opportunity. Hope you and your family have an awesome summer.
We will. Thanks, man.
Thanks.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.